Not only did the stock market decide to participate in its own version of March Madness, the bond market decided to join in as well. Stay tuned as we go over the news stories that may have triggered the sell-off on Friday, and also a concerning chart pattern that's starting to form in the S&P 500.
As Matt mentioned, the U.S. markets were down sharply just on Friday after a pretty quiet beginning to the week. The Russell 2000 on Friday was down over 3.6% and down just over 3% for the week. Now, the Russell is still up about 11.6% for the year. The NASDAQ was also down just on Friday about 2.5%, and the S&P 500 was down 1.9%, so just under 2% just on Friday. Now for the week, the S&P 500 was down about 0.77. Year to date, the S&P 500 still up about 11.7. Foreign and emerging markets were also down on Friday, but also for the week. Foreign markets down about 1.9, and emerging market stocks were down just under 3%. Now after that last week, foreign and emerging markets are up still about 8.6 and 9.4% year to date. We're looking at a chart of the S&P 500 again today, and what could potentially be a head and shoulders pattern forming right here. Now the sell-off on Friday could have confirmed that this head and shoulders pattern is forming. So you may be wondering, what exactly is a head and shoulders pattern, and what does that mean? So a head and shoulders pattern is just that. It's a pattern that looks like a head and two shoulders, as you can see on the chart in front of you with the three blue lines. Now there are three peaks on this chart. The middle one would be considered the head, the left and the right are the two shoulders. And normally, this pattern can predict a bullish to a bearish trend reversal. And this type of pattern also is believed to be one of the most reliable trend reverse patterns out there. So I want to take a second and mention a couple of the levels that we saw here on this pattern. So the first shoulder, which is the blue line to the left, was at about 2875 on the S&P 500. From there we saw the head form right around 2950, and that was the all-time high that the S&P 500 put in 2018. After that we saw the sell-off in December, and after that the rebound up until where we are today, which could potentially be the second shoulder forming on this pattern, right around that same level as the first shoulder at 2850 to 2875. Now, if this pattern is confirmed and it continues, then we could be looking at about 2575 to 2600 as the first level that this may be dropping to. Now, after that, we could potentially see the S&P 500 drop down to the lows that we saw back in December.
There were three major news stories that we wanted to cover from last week, and the first being the Fed meeting that wrapped up on Wednesday. And during that meeting, the Fed stated that they're going to be pausing rate hikes for 2019, and they cited the fear of a possible global recession on the horizon. Also, their rhetoric coming from this meeting was very dovish. Now, you may have heard of the term dovish or hawkish and really don't know what they mean. Well, the term dovish can be viewed as being conservative with rate hikes moving forward, and hawkish is being overly aggressive with rate hikes in the future. The second news story that we wanted to cover was the yield curve. And on Friday, the yield curve inverted as the 3-month Treasury bill yield rose above the 10-year Treasury note yield. And this means that on Friday, if you would have actually purchased that 3-month Treasury bill, they would have paid you more interest than if you would have purchased a 10-year Treasury note. Now, this is the first time that this has happened since 2007. So we're going to have to continue to watch the markets closely, as we all remember what happened after the year 2007. The last news story that we wanted to cover occurred over the weekend as Robert Mueller delivered his report to the Attorney General. And the Attorney General issued a letter on Sunday citing no collusion between President Trump and Russia. And this could be good news for the market, as now political risk is probably off the table. So this week we're going to be watching closely to see how the markets start to react to the inverted yield curve, and also if there's any additional fallout from the Mueller Report.
Also, we have more news coming out of the foreign markets this week, as there's going to be another Brexit vote, and also there's a lot of economic data coming out of the Asian markets. Thanks for watching as we strive to give you everything you need to know about the markets in 5 minutes or less.
If you're watching on Facebook, please like and share our video. And if you're watching on YouTube, please like our video and also subscribe to our channel.